Having a look at what's happening with precious metals now, we are very pleased to be speaking to Jeff Rhodes, Global Head of Precious Metals and, of course, CEO at INTL Commodities. Jeff, good morning. Thanks for speaking to us.
Yeah, good morning, Brandy.
And a becalmed gold price as it was, 1603 this morning, pretty much the same as when we spoke to you last week.
Absolutely, and the week before, It's quite incredible, really, the way gold has just moved straight across the page over the last couple of months. And it does remind me very much of back in the early 80s after we'd gone to an all-time record of 850. Then we had a year or so of action, and then the market flatlined for 2 or 3 years. It looks the same to me, the same kind of pattern. And when I look at the price at 1600 and take a look at the charts and where it could go to, I see very, very clear parameters of, on the upside, 1700 and on the downside, 1500. And we've got a 30-day RSI of 50, so exactly neutral. A colleague of mine here was asking, so what do you think this morning, Jeff? And I said, get out your coin, toss a coin. It could easily go either way. If I had to have a position, Brandy, as you know, I'm friendly to gold, so I would be long, but I think at the moment it's just as well to stay on the sidelines.
Well, while we are talking about staying on the sidelines, what are the reasons that gold has been in the doldrums? I mean, some of the data that we're seeing coming out, strong PMI from China, I've seen analysts say would normally have a bit of an effect. We've got everything going on in Cyprus, Korea. Is it just a wait and see?
Well, it is. I do think that with the rally in global equity markets led by the Dow, it prompted outflows of investor money from gold into equities, and that definitely had a bit of a bearish effect on the gold price, and indeed was looking a bit shaky, certainly when we first broke below 1600. But then, as you say, Cyprus happened, and the effects of Cyprus will be long-term in terms of gold on the bullish side. So we had Cyprus, we've got the problems in the Korean Peninsula, and so there are bullish factors that have come along, if you like, to counter the bearishness of a strong equity market. And so it's led to a standoff, and as I say, you pay your money and take your choice. But I do think, I have to say, that you can look at this period around 1600. Is it the end of the bull market where it's tired, or is it a period of quiet consolidation? I think the latter, actually.
Well, Jeff, not only is the gold price roughly where it's been for the last couple of weeks, the gold price now is just about where it was 2 years ago as well. And given that gold just sort of sits there and stares at you, it doesn't give you an annual dividend or anything, has it made it much harder to sell over that period?
Yeah, and typically that would be the case, Malcolm, in normal markets. But if you sell the gold and get your dollars, what are you going to do with them? Put them on deposit and get 0%? That's the key, for me, the key factor that's behind gold's rally over the last few years, and certainly in the last 2 or 3 years. The fact gold is not competing with dollars for yield. There is no yield on dollars. It's zero if you have your money in the bank, and even if you put your money there for 1 year, you get 1 or 2%. And so I think that this interest rate factor, which you rightly pick up on, is really important.
So I know we've talked before about what happens when the interest rates start to go up again in the States, and now seeing sort of even now gold is sort of, I suppose maybe in the doldrums is a bit strong, but it's flatlining at the moment. When those interest rates start to go up in the States, what do you think that'll mean for gold?
Real positive interest rates. Let's say we get to positive interest rates of 2%. The game will be up in gold. That really will be the end of the bull market. And if you project 2 or 3 years ahead, I'm sure that will be the case. I mean, we just can't stay at zero interest rates forever. So at some point, we're going to get nominal rates going up and real interest rates going up. At that point, the bull market will definitely be over. It depends where gold would collapse from. I mean, it may be 2,500 by then. I don't think so. But it certainly could be 1,900. And then we may see it then back to 1,600. I feel myself that in this area of like 14, 15, 1,600, it's probably fair value for gold these days.
I was amazed to learn the other day, Jeff, that since the year 1500, only 100,000 tons of gold have ever been mined, and that would fit into a cube with 20 meters sides. In other words, not very big. One other thing that surprised me was that it's estimated that there are only about 20 years worth of easily mineable gold left in the world. What do we do then, Jeff? How do we get it out of the ground? Is the gold there?
No, there you go. I mean, that's exactly the reason why the bulls are so friendly to gold.
Presumably the price goes up when it's harder to mine.
Exactly. Look, there is a certain amount of demand for gold year in, year out, culturally, for investment purposes, certainly in our region, in subcontinent, in Southeast Asia. There is a fundamental belief in gold, and money will always be put into gold. Now, if we run out of gold, in the ground, then that's very bullish. But the actual amount of gold that's been mined since history began is around about 170,000 tons. So, but that's really not that much. But of course, the fact that gold cannot be destroyed is also a bit negative, because all the gold that's ever existed remains in the world. It's not like oil, carbons. You get oil out of the ground, you use it, it's gone. Unfortunately for gold, any gold that comes out of the ground stays in the market. So, but the fact that you just can't go and dig out more gold is bullish, and that's why people who don't like paper currency like gold.
My mum was always losing rings, but I suppose it stays in the market, but just with somebody else.
Yeah, she might have lost it to maybe your dad.
I'll tell him you said that. We always ask you about India. How's that looking at the moment?
It's good, actually. Year end is over, so we're seeing very good demand, both in gold and silver. Silver we haven't touched on. Silver's weak. The one thing that we should talk about, silver a week or so ago was $29. Today it's just above 28. So that's been sort of fading away a bit. But very strong demand from India for silver, and really decent demand this week for gold. So I think the physical demand that we're starting to see come into the market will underpin the gold price. And certainly in silver terms, between 27 and 28, I really can't see the price moving below those levels.
Well, Jeff, let's have a look at what's happening this weekend with this upcoming Dubai Precious Metals Conference that's being held here. 500 delegates expecting from all over coming from all over the world. What are we going to see come out of it?
Well, it's sort of the great and the good of the global precious metals industry are congregating here. Look, the theme really is about the supply of gold, the supply chain. Dubai and the DMCC are taking the lead in ensuring that the gold that actually comes into the market is responsible, so that, trying to avoid conflict gold and ensuring that we know the provenance of gold. So I think the theme of the conference this weekend will be about the supply of gold. And I think, everyone should take notice of what comes out of that conference. I think it's very positive. And I think it's a great thing for Dubai that it's hosting such a major conference.
Well, the other thing that is going to come out of this conference is, of course, a book launch, a new book from Francesca Taylor called Mastering the Commodity Markets. And I understand that you are the author in a chapter of that.
Well, yes, it is a book produced by Francesca. It's really an educational piece, and I was delighted and really proud to be asked to contribute the section on gold. So I'll be involved in that this coming Saturday, and it's not for me to say, but certainly I think it's anyone that really wants to understand commodity markets, it's almost a must-read. Certainly the parts apart from gold, that is.
Oh, yes, sure. No, I love the modesty, Jeff. If any of your fans want to attend the launch, maybe get a signed copy from yourself, where do they need to be on Saturday?
Almas Tower, 5:30 p.m.
I'm glad you added the PM. What's your top tip for mastering the gold market that you have included in that chapter?
Well, look, I just think that you just need to really understand the market and study it. And as a top tip for trying to make some money, if you don't really understand what you're doing, don't do it. But if you study the market, and I think the key, regard gold as a currency. It's actually not a commodity. It's a currency. If you look at gold as another currency and you're good at FX, you'll be good at gold.
And I guess one of the tips that you're always giving us here is don't overweight yourself. 5 to 10% of your portfolio is about the recommended.
Absolutely. You know, when things are looking good, when the world's okay, 5% is fine. You know, you don't need much of an insurance. When you think things are not so good and really uncertain, then you need to be going up to 10%, and in the extreme maybe 15%. But between 5 and 10% is the right way to hold gold. And the best way, of course, in this part of the world to hold gold is actually in jewelry. Buy jewelry for your loved ones, and not only will they love you even more, but you'll have a store of value.
I love that idea. Jeffrey Rhodes, Global Head of Precious Metals and CEO at INTL Commodities. Thank you for joining us this morning.
More than welcome. Take care, guys.